Hi, I'm Jimmy. In this video, we're going to look quickly at where growth could come for the US economy and how it's possible that the very same factor that could give us a ton of growth could also be a huge drag on economic growth. Okay, so let's not waste any time and jump right in. So one of the biggest drivers of a strong economy is to have a healthy consumer. Ideally, we want consumers that are earning good money, they're seeing wage increases, they're spending money, they're starting new businesses, they're making investments in their own personal and business lives. And by having these types of features, well, the economy is likely to do very, very well. And with this idea in mind, well, this is one of the main drivers why governments around the world have been pushing so much stimulus as the coronavirus has attempted to slow this stuff down. So I think that part is obvious. The government stepping in to try to keep businesses afloat, try to get individuals to have more money to be able to spend that money, pay their bills, things like that. If they can do all of that, well, that should keep the economy moving forward. And then once the coronavirus is gone, well, hopefully things can push forward once again. But now we have an interesting piece of data. So the BEA, which is short for Bureau of Economic Analysis, well, they put out this data, and this is salaries and wages over the past few years. And basically what this does is it tracks all the income received by households, not just from their jobs, but it could be wages or salaries, or maybe it's if they own rental properties, the rental income, the stimulus that they get. Pretty much everything that a family brings in is tried to be accounted for here. And we might notice that two big dips happened during this time period. First was the financial crisis, and the second was the most recent COVID dip. And these two dips were similar to each other in size on a percentage basis. Sure, the most recent one was a bigger drop, but on a percentage basis, they're about the same. The first one, which happened at the financial crisis, well, that was about a 6.1%. Most recently, we had about a 7.5% drop. So close to each other. But what really interests me about this data is the shape of the recovery. In the financial crisis, well, we saw it took a few years for family income to get back to where it was. This is the very prototypical definition of a U-shaped recovery. Whereas the COVID bounce was much more of what they call a V bounce, as we might be able to see exactly why they do that. And I'm sure we can agree that a lot of this bounce happened because of what the government was doing, whether that was for businesses or families. Either way, the government threw a lot of money into the system. Sure, we can make the case that back during the financial crisis, well, there was stimulus done back then, but it was far more aggressive this time. Okay, simple enough. But now we get to the more interesting data. So this is a chart also from the BEA, and this is what percentage of people's disposable income are they saving. This chart includes the tech bubble, the financial crisis, and the most recent COVID crash. But we can see that this spike in savings, which generally happens when people are uncertain about, their economic situation, well, these spikes aren't even close to the previous time periods that we've looked at. And I suppose this makes some sense since nobody's ever really seen anything like the coronavirus before. So I understand that this is going to have a more dramatic impact on people. So I understand people being nervous and wanting to save more money. But this chart here, this chart is the approximation and the amount of money that people have deposited into checking and savings account. Now, this data actually came from a few different places. Most of it comes from the Federal Reserve. They do a flow of funds data, and they talk about money deposited into banks. But basically, what this data tells us is if we look at this trend line higher, well, there's going to be a gradual increase in the amount of money being deposited. You can get that from inflation. You can get that from some wage increases. You can get that from population growth. So it being a somewhat gradual increase makes a lot of sense. Now, of course, when we think about the U-shaped recovery that we saw in wages back when the financial crisis happened, well, that would help, at least partially, explain the dip lower in the amount of money saved on average in checking and savings accounts. So there's a slight dip lower there because people are earning less. That, after all, was a recession. But now this brings us to the current day. And by the way, this data is quarterly data. So when I say current day, I'm actually talking about this data goes up to the third quarter of 2020. But if we look at this huge jump in money going into checking our savings accounts, well, this has the potential to have an enormous impact on the economy over the next few years. So I think that the first question, the most logical question, is how did this happen? Well, many people are nervous about COVID. We know that. We've already talked about that. And we could be asking, how long is COVID going to last? And then suddenly people are faced with having to answer the question, are we certain we'll be able to continue to make money? So that question alone should be enough to get people to save more money or put more money in the bank. Combine that with millions of Americans who had jobs, or perhaps they still have jobs, but they're no longer commuting to that job. Maybe they're still working from home. I live in New Jersey, and nearly everybody I know is working from home right now. Because people are working from home, well, now you don't have commuting costs. So that's a good thing. Most restaurants are closed, at least they are around here. So not many people are going out to eat, is saving some expenses that way. Many of the tourist attractions around the country are closed. So that gives us less of a reason to travel. So again, less expenses, less need for people to spend money. So in theory, you end up with more money in your bank account. Now on the flip side, unemployment is also way up, and many people cannot earn enough money to survive. So to try to help offset that, well, the government stepped in. They did some extensions for unemployment insurance, which is helpful, but still not working nearly as good as it should be. And then the government also tried to go in the stimulus route, like we mentioned before. They paused evictions in many cases and allowed many people to postpone making payments on their mortgages. So again, that's a giant reduction in expenses. So that could add to some of this capital. But now this brings us to one of the main questions. Estimates have these excess deposits in the amount, they are estimating that this amount is almost $2 trillion above where it would have been. So now the real question is, as the vaccine gets rolled out and things gradually go back to normal, what do people or what do families do with this money? Do they keep it in the bank? Or maybe they go on vacation and go on some crazy spending spree? Or probably more realistically, they do a combination of the two. Maybe they take a short vacation, spend a little bit, but then they keep a decent amount in savings as well. Plus, if it hasn't already happened yet, well, people are going to have to start paying their mortgages again. So it's likely that that's going to take away at least some of this giant increase. But the answer to the question, what do people do with this money, is crucial. Just to illustrate, this is a formula for one of the ways you can calculate GDP, which is short for gross domestic product. And here, consumption is basically consumer spending. And it's estimated that consumer spending accounts for about 70% of all of US GDP. So if the consumer doesn't spend, well, GDP is going to have some real problems. But on the flip side, if the consumer goes out and starts spending all this excess cash, well, again, the economy could really start rocking and rolling. Now, of course, this isn't the only factor to consider. Unemployment is a big part of this as well. Sure, many people have excess savings from not paying their mortgage and not having commuting expenses, things like that. But there are many, many people that have way less cash, that don't have nearly enough money, they lost their job and they don't know if their job is coming back. So again, we have a long way to go. It's not as simple as the people who have the money should spend it. There's other factors to this. But if these people don't spend that money, that could be an interesting problem. I think one of the ways this could get interesting is that one of the purposes of all the stimulus the government is that the government is doing is to try to get people to spend. If people are hoarding this cash or even just moving that money into the stock market, well, the government might go out of their way to try to keep giving people money, try to keep spurring spending. And if that's the case, well, you could end up with some real problems inflation-wise. So from an investment standpoint, I think that many people would probably agree that the stock market, broadly speaking, appears to be overvalued right now. But still, with the possibility of higher inflation, I still think that with crazy low interest rates, what are we going to do with this cash? Are we going to leave it in our bank account? I still think investing it makes a lot of sense, but investing it strategically. Now, I recently did a video where I took a closer look at the possibility of hyperinflation coming to the United States, thanks to all the money that the government is printing, all the stimulus that they're doing. So if you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.